Coming out, I am going to be talking about refinancing and whether you could be saving thousands by refinancing and restructuring your mortgage. So I'm going to talk about a number of different things, not just about whether you can be saving interest on your mortgage, but also about why to refinance in general. And of course, the thing that most people I think are here for is, are you paying too much in interest? So we'll be talking about that. Here's a table of contents. So I will be talking about the basics of refinancing, why refinance, and some of the reasons are to pay off debt, invest, save an interest, and changing the product, and talking about a home equity line of credit. I also will be talking about how rates are determined, how penalties are determined, and running the numbers and figuring out whether it makes sense to refinance or not. So first of all, let's just talk about the basics of refinancing. So anytime you are restructuring your mortgage, you are refinancing. So sometimes I have people wondering, is this a refinance? Anytime you're changing the core structure of your mortgage, whether you're changing the amortization or you're increasing the loan amount, that would be considered a refinance. A key important component here is that the refinance cannot exceed 80% of the property value. That's a requirement that the government actually set out a few years ago. Back early in my career, back in 2006, 7, 8, you used to be able to refinance up to as high as 95% of the property value. I think it was around 2010 or 2011 or so that they changed the guidelines where you could no longer refinance past 80% of the property value. Oh, sorry, the clicker all of a sudden had an issue here. And yes, Arena, we will be sending out a copy of the recording to everybody. A renewal or a transfer, and this is an important distinction, a renewal or transfer does not restructure the loan, even if you're changing lenders. And the reason that I bring this up is that a transfer or a renewal doesn't actually mean that you're restructuring or refinancing. That may mean that you qualify for a lower interest rate. So sometimes when you look at the pricing for lenders, sometimes they have a different price for a refinance than they do for a straight renewal or switch. So sometimes when you're dealing with a mortgage broker or another lender, sometimes they will say, hey, I can give you a better interest rate if you do a transfer or a switch in, as opposed to doing a refinance. And that's just because it fits a different bucket. That is something that you might want to consider or take a look at. A refinance, extending amortization out to 30 years, for instance, does fall into a different pricing bucket, and sometimes the rates are a bit higher. So just something to keep in mind. So let's talk about why refinance. And there's really 4 different main reasons that somebody would be refinancing. And the first one is to pay off high interest debt, or for renovations. And really, I lump these into the same category because if you're paying off high interest debts, then that also means that you might be not putting aside money to pay for your renovations. So I basically lumped it into the same one here, because if you do renovations on high interest debt, like an unsecured line of credit or credit card, that's where your interest costs will be quite a bit higher. In general, borrowing against your real estate, secured real estate lending is much cheaper of an interest rate. And so you're typically going to be looking at interest rates that are, currently right now 2% for a mortgage. If you borrow against unsecured credit, like a credit card or unsecured line of credit, rates are anywhere from 6 or 7% for a line of credit, all the way up to 19% for credit cards. So it's really important that you eliminate those credit card debts. And one of the main reasons to be looking at refinancing is if you're doing a consolidation loan and paying off a lot of your high interest debt. Another reason, of course, to do this, and this is something that we talk about a lot, is investing or borrowing money to invest and accessing capital for investments. So you can invest in stocks, real estate, and anything you're investing in doesn't really make a huge difference. But as long as you're borrowing money to invest, the interest portion of the payments is tax deductible. So again, I'll repeat that. Anytime you are borrowing money to invest, the interest portion of the payments is tax deductible. So this is something that we do a lot here in our office. A lot of our clients are real estate investors. And so a big part of what we do is refinancing to access equity to then borrow to invest. And that would be a down payment for a rental property or borrowing money to invest in stocks, for instance. Obviously, one of the main reasons to refinance is to see if you can lower your interest costs. And that's where we need to look and run in the numbers and see, if you save money. You may be saving interest costs by refinancing at a lower interest rate. And sometimes the penalty to break your mortgage could exceed the savings of breaking your mortgage. And that's where we really need to work through and run some numbers to see whether it does make sense or not. And one of the final reasons to consider restructuring or refinancing is to get a different product, a home equity line of credit, for instance. And I did actually do a webinar last month. And so if anybody's interested in that, there is a recording available on that. But there's something called the Smith maneuver. And basically what that is a fancy term for utilizing your equity in your home to borrow against it to invest in real estate. Or invest in stocks or whatever you'd like to invest in. And it's a way of creating a mortgage that is more tax efficient. And so again, I'm not going to go into too much detail because I did do a webinar on that last month. But for anybody that's interested in that, you can check out that webinar on our website. And I will touch on it very, very briefly today as well. So let's talk a little bit about the first option. So paying off high interest debt. If you're borrowing on your mortgage and let's say a line of credit rate is 2.95%, if you increase that mortgage on your residence to pay off and eliminate your consumer debts, you're basically saving the spread on the interest rate. And a lot of the things I'm going to talk about tonight are all about creating a spread. If you're borrowing against your mortgage at 2.95 and paying off 19.95% interest, you're saving 17% on that money. Now, if you're refinancing your residence to pay off $5,000 or $10,000 in credit card debt, it's probably not enough money for you to be really realizing and recognizing the savings. It's not a significant enough amount for you to go out and do that. It might be better or cheaper for you just to get a line of credit, an unsecured line of credit. However, if you're paying off $50,000, 17% on $50,000 is a substantial amount. That's $8,500 a year in interest costs that you'd be saving. So it is something that you'd want to look at, especially if you're carrying a lot of debt. It definitely makes sense to refinance and restructure if you're paying off some of your higher interest debts. On this note too, I should mention that sometimes it's not even just the interest rate, but sometimes it's the payments. So a car loan is a great example. Sometimes a car payment might be $500 a month for $25,000. That payment itself, as a function of the amount you're borrowing, is very high, considering a mortgage payment might be $400 to borrow $100,000. So you might be able to save a lot of money on your payments to refinance and lump all of this money into a mortgage where the A, interest rate is lower, and B, the amortization is longer. So that's something to consider too. Sometimes we do this a lot when we're trying to restructure debt in order to help clients go out and qualify for more rental properties. And sometimes even if the car loan is at 0% interest, we actually need to roll the car into it because the payments of borrowing that same amount of money on their mortgage are actually lower. And so this may be a way that we restructure things in order to increase borrowing power. Another thing that we'd look at here too is borrowing to invest. Same example here, but now we're investing money at, let's say, a rate of return of 8%, and we're borrowing against that money. And let's say that again, we're using a line of credit. A line of credit typically is a higher rate than a mortgage, by the way. But in this case, you're basically taking money you don't even have in your pocket, and you're just creating a spread on it. And so per $100,000 in this case, you'd be making $5,000 per year net after your expenses to invest this money at 8% and paying about 3% on that money. So again, investing is a very, very deep topic, and I don't have enough time to talk about that today. But if anybody does want to learn more about investing in real estate, you can definitely reach out to us. And we have a lot of content on our website that would teach you more about how to invest in real estate. Third item that we talked about very briefly is saving and interest. And that's where we need to run the numbers on savings versus penalty. It doesn't always make sense. It depends on which lender you're with and how much term you have left in your mortgage. And there are different pockets of time where sometimes it can make sense and sometimes it does not make sense in order to break your mortgage. And I will be talking about how the penalty is calculated and how to run the numbers on the savings a little bit later in this presentation. And the last thing I want to talk about is getting a home equity line of credit. And this is the fourth reason that a lot of our clients are refinancing. And so this is getting what's called a re-advanceable mortgage, which allows you to re-borrow the principal that you've paid down back out on the line of credit portion. And so basically what happens is, as you pay down your mortgage, your line of credit limit slowly increases. And so you get approved for a total global limit. So in this example here, a HELOC product might have a global limit of $400,000. So as you pay down your mortgage from $400,000 down to $225,000, your line of credit available limit would increase up to 175. And you can borrow that money out, and now you can use that and borrow it against it to invest. And whenever you borrow money to invest, the interest portion of the payments is tax deductible. So this is a concept that I did go into last month. And so if anybody wants to learn a little more about the Smith maneuver, check out the webinar that I did last month. And I also have a few of these books at my office. If anybody would like a copy of the book, just send us an email at info@greenmortgageteam.ca. And I'm happy to send you over a copy of the Smith maneuver book, which goes into a lot of the things that I talked about last month's webinar. So let's talk about how much you could save. And the answer is a lot. I've had a few clients that were looking at refinancing, and a few of them were able to save $10,000 or $15,000 by refinancing. I've had some cases where the number could be as high as 70,000 in my career. It's not very common that you have numbers that are that high, but sometimes it does make sense, and it definitely is worth investigating and looking into for sure. So one of the questions we get a lot is, is it now the time to refinance? And it really, it's hard to say because it doesn't always make sense. But here are some situations where it definitely almost always makes sense to refinance. And the first one is if you're paying off enough high interest debts, then it almost always makes sense to refinance. Another reason is if you cannot get that much capital by other means. Keep in mind that a secured mortgage is one of the safest ways for lenders to lend you money because it's secured by an asset that generally appreciates in value over time. So it is very difficult, for instance, for you to get $200,000 unsecured through credit cards, lines of credit, et cetera. And so this is where it almost always makes sense if you need to get access to a large amount of capital. Another reason that it almost always makes sense is if there's a large and obvious tax savings, and that's talking about the Smith maneuver and figuring out if maybe there's a way of being a little bit more tax efficient. And there are certain circumstances where a situation may be more tax efficient than others. And the other reason, of course, is if there's a significant interest savings spread between your cost of borrowing and the current mortgage that you're in. So I do want to talk about interest rates. It's something that comes up quite a bit. Obviously, the question of will interest rates go up or down, always an interesting topic to talk about. So, of course, I don't have a crystal ball. If I did, I probably wouldn't be working right now at 7 p.m. on a Wednesday night. So I will talk to you about, however, the way that interest rates are calculated, because this here is actually my crystal ball. And I do have the ability to predict interest rates a little bit in advance. What I've pulled up here is the 5-year bond chart. I just go to investing.com to locate and pull this up. That's the easiest source that I found to grab this. If you follow this bond chart, you'll be able to tell when interest rates are changing. So you can see that on this chart, there's a recent tick up with bond yields. That means that fixed rates are on their way up a little bit. So if you follow this, it's very, very easy actually to follow and see where the bonds are heading, and therefore where fixed rates are heading. If you see bond yields go up by 0.1 or 0.2%, that's usually a trigger that fixed rates will go up about 0.1 or 0.2%. The reason for this is that lenders will bundle up mortgages and sell them. And international investors can either buy a bundle of mortgages or they can buy what are called mortgage-backed securities. When they buy these mortgage-backed securities, the pricing is very tied in to where bonds are at. And so you can see that because they can either buy a bond or a mortgage-backed security, they're very tied together. And in general, if you add about 1.2 to 1.5% on top of the bond yield, that's a rough idea of what you're looking at for mortgage pricing. So very simple and very easy to determine what interest rates are going to look like. Now, that's not the full story. There's also variable rates. And so this is how the prime rate is determined. The Bank of Canada meets about every 6 weeks to determine if they're going to make any changes. And the Bank of Canada is looking at things from a macroeconomic perspective. So what is happening with inflation? What is happening with growth? What do we need to do in order to either promote growth or to stunt inflation? Those are their two common things that they're looking for. In general, the Bank of Canada's target for inflation is about 2%. And so when they're underneath that target, usually trying to keep interest rates low. When they're over 2% inflation, then they're typically trying to increase rates in order to slow down inflation. Inflation is a very risky thing, and they don't want inflation to run away. And so this is the variable rate. So anybody that's in a variable rate, if the prime rate moves up or down, this means that your pricing and your interest cost will therefore change. That's not the full story though on anybody that's getting into getting a new variable rate, because it's not just the prime rate; it's also the discount or premium over or above or below the prime rate. So what I have here is the LIBOR chart, the London Interchange Bank rate, basically. And what this is it's an international money market. And the reason I have this pulled up here is because this is actually a decent determinant as far as what's going to happen with variable rate discounting. And so when you see large fluctuations up or down, this often means that the variable pricing or variable discount is getting compressed or being increased. This is not the be all and end all of what variable discounting is looking like. But if you notice a trend in one direction or another, it often means that variable pricing is going to change. The other thing that you can also watch if you're really nerdy is you can also watch the VIX, which is the volatility index. And a high volatility usually means a smaller variable discount. Low volatility usually means a deeper variable discount. So that's something that you can also watch. The reality is, unlike watching fixed rates via the bonds, variable rate discounts are very, very difficult to predict. There's a lot of moving parts, and these are just some of the parts. There's another part called the 1 month treasuries, et cetera. And again, that's another factor that is evaluated. So it is harder to predict what's happening with variable rate discounts. But of course, the prime rate is actually one of the easiest things to predict because the Bank of Canada usually takes a stance and usually have an idea of where they're heading. So it is easy to know where the prime rate is heading in most cases. So looking at determining, if we have an idea of where interest rates are heading, we also need to figure out, well, how much is it going to cost me to get out of my current mortgage? So the first thing is, if you're in a closed variable rate, the penalty is just max 3 months interest. Sometimes the lenders will charge it based off of the actual rate, and sometimes they charge it based off of the prime rate. But in general, that cost is quite low, and so breaking a variable rate contract is usually quite cheap. This one here, the closed fixed term, this is where the interest cost can be, or the penalty cost to break it can be significantly higher, and that's the greater of 3 months interest, or something called the interest rate differential penalty, which I will get into in a slide or two. And then there's the open variable. So this one actually has no penalty to break it. It is priced at a higher rate than a closed variable in most cases, and so you are paying for that flexibility. For instance, usually a closed variable term is prime minus, whereas an open variable is prime plus, like a line of credit, for instance, is open. You do need to make sure that even if you think you're going to break the mortgage early, it may make sense to still go with the closed variable, because you have a break-even point that varies, but usually is between 6 and 9 months, sometimes as long as 12 months, sometimes as short as 6 months, but usually about 6 or 9 months, where even if you broke your mortgage, if you had that mortgage in effect for at least 6 or 9 months, the interest savings of being at the lower interest rate equals the 3 month interest penalty. And so a lot of people think, oh, I might be breaking my mortgage early, I should go open. But the reality is that they'll probably end up paying more in total costs because the interest rate is higher than if they just paid a lower interest cost and then paid a penalty when they broke the mortgage. So something to consider if you're thinking, should I go with a closed variable or open variable? Just keep that in mind. And our clients that are doing flips, for instance, will often be looking at an open variable, but somebody that might be selling their house in 2 years, probably better to take a closed variable. So let's talk about IRD penalties. This is the big one, and it's not cheap. So let me give you the definition. It's the difference between your rate and current market rates for the same term remaining. Okay, so the difference between your rate and current market rates over the same term remaining over the remainder of the term. So this is something that you want to be taking a look at and making sure that you understand exactly how an IRD is calculated. And I'm going to go into a situation here as well with a bit of an example. So let's say that you have a mortgage that has $500,000 owing on it. If you had a 3% mortgage for 5 years and you had 2 years remaining, if the current 2-year rates were 1%, then the penalty cost would be the 2% difference on that amount over the remainder of the term. So 2% on $500,000 for 2 years would be $20,000, which is quite steep. And I know that seems a little bit crazy that your penalty on a $500,000 mortgage could be $20,000, but that's actually routine, especially when interest rates drop substantially. And I will go into a more specific example here, pulling up a current bank's actual interest rates and going through that exercise with you as well. So it's not a pie in the sky situation. So let's just compare how a bank calculates this, because we don't just deal with banks, we also deal with non-bank lenders, credit unions, etc. And here's how they determine, and this is where they get you. This is how they determine what the magical mystical rate they're going to use to calculate your penalty is. So they're going to find the original discount off of the posted rate, and then they're going to find the closest posted rate rounded to the term you have remaining. And here's the thing, they're going to take that posted rate for the term remaining and subtract the discount off of it to calculate the rate that they're going to use for your penalty. And a non-bank lender just looks at the current posted rate for the term remaining, and that's it. So what's happening here in a nutshell is the banks are manipulating their posted rates and their discounted rates in a way where your penalties are going to exceed your savings in many cases. I'm going to go through a specific example here to illustrate this. And so if you took a mortgage at 3% about 3 years ago, the posted rate at the time was probably around 5.34%. So you got a discount of 2.34 off of your posted rate. Now, if I take a current 2-year posted rate, that might be about 2.94% right now with a lot of lenders. So they would take 2.94 and subtract the discount they gave you initially off of your 5-year fixed of 2.34, and the rate they're going to use to calculate your differential is 0.6%. 0.6%. So here's the problem, is the bank isn't running around offering 2-year fixed rates at 0.6%, and yet that's the rate they're using to calculate your interest rate differential penalty. So that's where the banks are using a bit of an unfair calculation to burn people on these penalties. When you're dealing with a non-bank lender, they would just say, well, our current 2-year rate is 1.94%. And so they would use that interest rate to calculate your penalty. It's a lot cheaper. And the reality is the spread. And so if you look at the difference, so in this case, it's a difference of 3% and 0.6%. So that spread is 2.4% that they're calculating to determine the penalty in the bank example. And in the non-bank example, it's 3% versus 1.94. So the spread is 1.06%. The spread is over double that they're calculating. And so let's look at what the penalties would look like in this example. So if you're with a major bank, your penalty would be $24,000 to break that mortgage. So a $500,000 mortgage with 2 years left at a good rate at the time of 3%, that penalty would be $24,000. The non-bank lender, their penalty would be about $10,600. And if you took a variable rate instead of a fixed rate, your penalty would have been about $37.50 to break your mortgage. And that's the 3-month interest penalty. So there's a pretty significant difference in those penalties, especially going fixed to variable, and especially with major banks. So that difference is 6.4 times greater, which is quite substantial. And this is why we often get into this argument of fixed or variable, and how do you choose do you go with a fixed rate? Do you go with a variable rate? And the reality is that there is more flexibility with the variable. It doesn't mean that you should be taking a variable, but there is additional flexibility. And so a lot of economists are predicting about a 2 to 3 year period of low interest rates. The ability to convert and lock it in at any point in time is also a nice feature. And the penalty is 3 months interest. So it's a more flexible product for those that might be redoing their mortgage. I would say that a lot of our first-time home buyers, maybe if you're going with a non-bank lender and you're not likely to sell your property in that time frame, then maybe a 5-year fixed may make sense. But if you're an investor and you're constantly redoing and refinancing all the time, even if you think you might end up paying more in interest by going variable versus fixed over that time period, you have the ability to potentially save thousands and thousands of dollars in the penalties to break that mortgage. And I have to say that, especially with investor clients, if you're constantly redoing things and trying to, access capital to invest and do more things with, maybe the lender that you get set up with in the beginning was the right lender for you in that period of time. And 2 years later, maybe you go to refinance and that lender is no longer a good fit for you because maybe your financial picture has changed and you don't fit their box anymore. Or maybe the lender's box has changed and now you don't fit that box anymore. So there's a lot of reasons that you may end up having to break that mortgage and pay a penalty to go somewhere else. So calculating the savings, the savings is actually the same as the penalty. It's your rate versus current market rates and over the remainder of the term. So really the savings and the penalty being the same, what it comes down to then is the rate that's being used to calculate your penalty lower or higher than the rate that you're going to get on your new mortgage? And that's what it really comes down to at the end of the day. And so that's where we do some calculations to figure out, where are things going to be, where are things going to settle? What kind of interest rate are you going to be able to get on your mortgage? And what is the rate being used to calculate the breakage on that mortgage? Now, that's not the full picture, though. There's another thing that we often look at too. And I just pulled up an example here. Let's say that you're at 3.5% right now for 2 more years, and you can get a new rate at 2.29%. However, we also want to assume that if interest rates are on the rise, and that's debatable, but if they are on the rise, then will interest rates be higher in the future than where they are today? And so you don't want to look at just what's happening in the remainder of your term, because sometimes you won't make money or you won't save money by refinancing, because over the remainder of your term, especially with a major bank, the penalty may exceed the savings. But if you also look at, well, where do rates have to be in 2 years when I would be coming up for renewal for me to be actually paying more in interest by just staying where I'm at and then renewing into a new 5-year term at that point? And so, of course, we would do some numbers and calculate that. In this example, for instance, maybe if you renewed it, if the rates go up to 3.2%, well, if you had 2.29 for 5 years versus 3.5, 3.5, and then 3.2, 3.2, 3.2, well, maybe in that example, maybe it would make sense. And so really what it comes down to is working out the break-even rate. And it helps to make a determination. That's something that we can calculate for you fairly easily using our spreadsheets in-house. We would look at, well, if you broke the mortgage, the penalties X, you're going to recoup certain amount of that money back on the savings of dropping the interest rate. But also, if rates are X% in 2 years, maybe it does make sense to refinance and work out how high rates would have to go. Sometimes rates have to go quite high and it doesn't make sense to break it. Sometimes rates only have to increase a little bit. And in those cases, it can make more financial sense. So I'll tell you what my general findings are here. And this is by no means a blanket statement, because every situation is different depending on the lender that you're with and depending on why you're refinancing. But here's some general findings. So in general, the penalty will exceed the savings with major banks. So if you're with a major bank, in many cases, the penalty will exceed the savings. Not always the case, but in many cases. In a rising rate environment, though, it may still make sense to secure a low rate instead of renewing in the future. And this just really depends on what's happening in the marketplace. If rates look like they're skyrocketing very quickly, it may actually make sense to break that mortgage and pull the trigger very quickly. So that's something to consider, is if it does look like interest rates are rising, maybe it does make sense to pay the penalty. Another thing I want to bring up here too, and it's always a bit crazy and it's hard to think about this, but when the world starts going nuts and starts going crazy, like it did in the subprime crisis and when COVID hit, these are great opportunities to refinance, because it's right before interest rates are about to plummet. And so if you can lock in your penalty at this spread before rates drop and basically pay a penalty based off of this difference, and then you go into a variable and you can ride the variable rate down, wave down as interest rates drop, and then you lock into a fixed rate at a lower point, then your cost of breaking the mortgage is based off of this spread before rates dropped, but your savings is based off of the new rate that you locked into later on in the future versus your original rate. So that's a great way of creating a spread on your cost of breaking versus your savings that you would realize by breaking the mortgage. Now, again, we don't have crises like this happen all the time. It's every X number of years. In this case, it was there was 12 years between these two crises. But things like this do happen, and just be aware of it. Usually, when bad things happen around the world, it is a good time to be borrowing money because usually central governments are flooding the market with money, and that will push the interest rates down. And so if you can pull the trigger quickly before the interest rates have dropped, then you might be in a position where you can take advantage of a market like this. Another thing I want to bring up too is if you have a variable rate and you have a very small discount off of prime, it may make sense to refinance into a deeper discounted variable. And so if you're at prime minus 0.3, for instance, and you can get prime minus 0.8, that's a big enough spread where it may make sense to break your small discounted variable and get into a deeper discounted variable, especially because the penalty is only 3 months interest to do so. So that's something to consider. And the last thing I want to bring up here too is that if you are considering going fixed, consider a non-bank lender to save on the possible breakage penalties if you do break that mortgage earlier or later on down the road. I will say this, one disadvantage of the non-bank lenders is they generally don't have the same type of products that banks do, meaning home equity line of credit products, or in order to qualify, products like net worth or other products like that. So sometimes deals have to go to major banks in order to get approved, or for you to get the product that you're looking for, like a home equity line of credit. But if you're taking more of a standard mortgage and you really want a fixed rate, it's definitely worth considering going with a non-bank lender because the penalty to break that mortgage is probably going to be a lot less. Now, all this being said, I've thrown a lot of numbers at you guys. I'm not sure how much is stuck, but just know that we can run the numbers and do the analysis for you. This is a snapshot of the spreadsheet that we use internally to run numbers and figure out, hey, does it make sense to break that mortgage or not? It also allows us to put in what debts you're carrying if you are paying off any debts to do this. And we can punch in the new interest rate that you'd be getting and whether you'd be saving money in the remainder of your term or not, and where interest rates would have to go in order for you to be, be in a position where you're saving money or not. So that's something that we can do for you and run all the numbers for you. If you would like us to do that, you can check out our website. We have a refinance questionnaire where we ask you a few questions. Not an in-depth application or anything like that. It's just the basic questions about your current mortgage setup. And with that information, we can very quickly assess your situation and give you an estimate on what your penalty would look like, and also an estimate on what the savings would look like, and figure out if it makes sense. So if you'd like to go into this or go into more detail and you really just want to talk to somebody and figure out, hey, should I be doing that Smith maneuver thing or what should I be doing? Of course, you can go to our website. You can book a consultation with us directly through there. I also want to mention too that on our website, we have upcoming webinars. There's another webinar coming up next month. We are doing webinars every Wednesday at 7 p.m., the first Wednesday of every month. And so we have our webinars that are upcoming on there. We have downloadable spreadsheets. I love spreadsheets. Our whole team loves spreadsheets. And we have FAQs on there as well. And if you need to reach us, you can contact us here. What I'll do now is I will answer some questions because I know that the chat has had a lot of questions. So let me go through this and I'll get through it. All right. So Angela asked, does the 80% loan to value apply to rentals as well? And in most cases, yes, most lenders will refinance and go up to 80% financing on rentals. However, in certain cases, you may not be able to qualify for 80% financing. So in some cases, if you have a large number of rental properties, some lenders start to scale it down. There are a few lenders that still do only 75% financing on rental properties, or even less in some rare cases. But most lenders do go up to 80% financing. There's another question about when we're investing, there's a question by bank if it's borrowed money. So I am assuming banks or CRA don't mind if we invest in TFSA RSPs with borrowed funds. Is it correct? So interesting point here. If you are borrowing money from your line of credit and wanting to invest it into a tax sheltered vehicle like RSPs or TFSA, my understanding is that that means you cannot write off the interest to borrow the money to put it into a RSP or a TFSA, because your tax savings is based off it being inside of the vehicle. You don't get to save money to borrow the money to put it in there, and then also save money by being sheltered inside of the RSPs or TFSA. So that's something you need to look at. I think the other part of your question too is the banks are asking, are you borrowing the money for the down payment? Lenders do allow, if you're borrowing money from a asset that you own. So a home equity line of credit is acceptable. If you're borrowing your down payment for future acquisitions from a HELOC, a home equity line of credit, that is an acceptable source of down payment. If you are borrowing money from a friend or family or from an unsecured line of credit or credit card, that is not something that's acceptable. And I have so closed fix would be cheaper as highest penalty. I'm not sure that I follow that. So maybe Rajit, if you could clarify that for me as well. Varshan, yes, this is recorded. And Monique, there is no cost for the consultation analysis. We're happy to do that for you. And if it makes sense for you to go through with it, then we can help you execute it or point you in the right direction. I'm just going to go through the Q&A as well. So Justin has a question. I'm just going to answer this live. So excellent presentation. How much equity as a percentage can we really expect to pull out of a typical rental/revenue property? So as I mentioned earlier, 80% financing is doable. So you can get up to 80% leverage. It does depend on your borrowing power. And realistically, the lenders are looking at what's called the debt service ratio to determine how much money you can qualify for. If you only own your own residence and you have no other debt, or you're going to be paying off the debt using the refinance proceeds, the basic math is that per 20 grand in income equals 100 grand on a mortgage. Okay, so 20 grand in income equals $100,000 in a mortgage. That's the basic math on it. So if you make $100,000 a year, you can probably qualify for about a $500,000 mortgage. This is not the be all and end all. Of course, there's a lot of nuances and whatnot here, but that's a very general term. When it comes to rental properties, the problem is that different lenders use different percentages of rent to qualify you. And that's a bit of an issue because it's hard to know, well, how much exactly would I qualify for, because every lender will have a different method of calculating the rent. So a bit more complicated. That's something that our team could definitely help you with. Jerry, hi Kyle, I joined late. Will this be posted, or can you email it to us? Yes, we'll send out a copy of the webinar here so that everybody can watch it later for sure. Alejandro, is there a difference between a secured mortgage and a home equity line of credit? Not really, no. A HELOC is a secured mortgage, and so a lot of people assume, hey, a home equity line of credit, do I have to qualify for that, or do I need this or that? It's the exact same process to get it. From a bank's perspective, it's the exact same thing. It is debt secured by your home. That's a mortgage for all intents and purposes. The only difference between a mortgage and a line of credit or a HELOC is that a mortgage is just a static charge. And here you go, here's your $500,000 mortgage, and that's it. And you're going to slowly pay it down. A home equity line of credit, they're a little harder to qualify for. And the reason for that is that they give you that amount, and as you pay down your mortgage, your line of credit limit slowly increases. And so it is a slightly different product when you're referencing a home equity line of credit. And I have an anonymous question. Would you consider 30 years or 25 years amortization for your principal residence, and monthly versus biweekly? So this is an interesting question because there's some pros and cons. So on a 25-year amortization, you can pay less interest for two reasons. Number one, the shorter the amortization, the more principal payments you're making on your mortgage. So the reality is, on payment number one, the interest portion is the same, whether it's a 25 or 30-year amortization. But your payment is higher because you're paying more towards the principal, which means that because you're paying more on the principal, on every subsequent payment, so payment number two, the interest cost is now a little bit less on the 25-year amortization than it is on the 30-year, because you now have a smaller outstanding balance on the mortgage. So that is number one. It's just that you are paying off the principal at a faster rate. The second reason to consider 25-year is that some lenders will have a better interest rate for 25-year amortization. So in many cases, the difference in rates can be about 0.1%. Sometimes in some cases, it can be a little bit lower or a bit more than that. But in most cases, it's about 0.1% difference on a 25-year versus a 30-year. So those are two reasons you save interest. On top of that, monthly versus biweekly. If you're doing biweekly accelerated, it effectively means that they take the monthly payment and divide it in half. And because you have 2 months of the year where you have 3 biweekly payments, not 2, you're effectively paying more towards the principal. Anytime you make extra payments on the mortgage, those all go towards the principal. So on a 25-year amortization on biweekly, the effective amortization is 22 years or 22 and a half. On a 30-year, the effective amortization is just over 26 years. So you do pay it off faster. All this being said, one of the considerations that with mortgage rates as low as they are today, it may make sense to be only borrowing it on a 30-year amortization and taking that extra cash flow and investing it into something else that returns a higher rate of return. So that is the question. The other thing too is that with a 30-year amortization, you have a lower minimum payment, which can help you qualify for more debt in the future. And on top of that, going with a 30-year amortization, especially if you, let's say you're self-employed, it can manage your cash flows a little bit better because you have a lower minimum monthly payment. So it really comes down to the circumstances and situation. But yes, a 25-year amortization can be better. And so it can bi-weekly because you're paying it off faster and you end up paying less in interest. But you can always go with the 30-year amortization, which gives you the lowest minimum monthly payment. And you can always make lump sums in the amount that you would be paying if you were paying it off on a 25-year or based on biweekly. And you can effectively pay it off at the same rate, but with more flexibility where you can choose to make that lump sum if you want to. Maybe financial situation has changed and you and your financial picture is not as strong. Maybe you don't make that lump sum on that mortgage. Justin had a question: how much net worth versus income salary affect viability of the refinance qualification? So net worth is not nearly as much of a factor as the income is. That same calculation of 20 grand per 100 grand, that's really black and white. However, some lenders do have a net worth program where either they can make a small debt servicing exception and give you a slightly larger loan amount, or some lenders do have a program where if you have a certain amount of net worth, then the door opens up where you may be able to qualify for more. So I'll give you an example. One bank in particular has a program where if you have $250,000 in eligible net worth, liquid net worth, then what they would do is they would look at how much you qualify for based on your income. And so let's say that you qualify for $500,000 based on your income, and you had $300,000 in eligible liquid assets. They would add the $300,000 to your $500,000 borrowing power, and they would say, well, based on the amount of liquid assets you have, you could qualify for up to $800,000. Under that program, most lenders will restrict you to about 65% total financing you can get on a net worth program. That lender in particular can allow you to go all the way up to 80%. So there may be some flexibility there, but long story short, most programs are based primarily off of the income you have and not the net worth. And that's partially due to the government really stepping in and wanting people to qualify based on their income, not based on the amount of assets that they have. Emad has another question. 2 years left on my 2 rental properties at 3.29 is good to refinance. Hard question to answer. One of the things that we'd need to see is which lender you're with and calculate the penalty to determine what the penalty cost to break that mortgage would be. And also on top of that, we need to figure out, well, what rates can you qualify for? Which lenders can we send you into, and see what the spread is there. So Emad, feel free to use the questionnaire on our website, or just email us and give us some more details on. If you have your most recent mortgage statement, that should have pretty much everything that we need, the annual statement, and we can work through that and figure out what the penalty versus the savings might be to refinance those. Alejandro has a question about what would the interest be when using the HELOC. Generally speaking, the line of credit rate is prime plus 0.5 with most lenders. So right now, prime is 2.45. That means that the interest rate would be 2.95 if you were to break it or to borrow it. I have some questions in the chat I'll get to now. Lots of questions, guys. This is awesome. Okay, so Irina, do I need to break the current mortgage to consolidate the high interest debt into the mortgage? So not always. If you have high interest debts and you're depending on the lender that you're with, sometimes you can just do a refinance with the same lender and you can add that extra money onto it. Some lenders will do a blend and extend, they call it, which means that they're going to blend and take the extra money that you're adding to your mortgage and blend it and create a new interest rate for you. I'll give you an example. If you had $100,000 right now in your mortgage at 3%, and you were adding another $50,000 in unsecured debts that you want to pay off, et cetera, into that mortgage, and let's say the rate was 2%, they would blend the amounts together. And so basically 1/3 of your interest rate would be based off of the new rate of 2%, and 2/3 would be based off of your current interest rate of 3%, because in total, you already have 100 grand, which is 2/3 of the total of 150 of what your new mortgage would look like. So your blended rate would be somewhere around 2.66% in that case. So you don't need to pay off the mortgage in full to access it. Sometimes also you can just add a line of credit component behind your mortgage, and then you're not breaking the existing mortgage to do that. William has a question. So I have a HELOC that's from 2014. I still have the HELOC, but would you recommend me to get the bank to reassess and get a bigger HELOC for future investments? And how does the HELOC affect mortgage qualification? So great question, William. In general, the answer is yes. It's good to go get a bigger line of credit, and then you have more money to access to then invest and make money off of, and again create that spread. However, one of the concerns is that in some cases, a lot of lenders right now are actually using the line of credit limit, not the balance, but the limit you have when looking at whether you qualify to buy rental properties moving forward. So there's a select number of lenders that are only looking at the outstanding balance you have on your line of credit, but most lenders now are looking at the outstanding limit. So you have to be careful. You need to make sure you're not shooting yourself in the foot by getting a big, huge line of credit limit and then realizing that now you have that huge limit, you can actually qualify to buy any rental properties. So that's an area that we can really help with, to do a little bit more planning to figure out, hey, William, if you did this, now you have these options to go out and buy rental properties, or you have no options at all, or what the circumstance would look like. And maybe there's a fine balance. But in general, because we still have a few lenders that can do it without using the limit, they use just the balance, it is usually still possible. And in most cases, if you need access to the money anyways, then you should just get access to as much as possible. Because if you can't invest, if you don't have it, then you might as well get the money and figure it out later. Armand has a question. If you use the HELOC for rental investment down payment and get a mortgage, the rent you earn should cover both the HELOC and mortgage. Wouldn't be positive cash flow, would it be? So the reality is it probably won't be positive cash flow. Especially if you're borrowing 100% of the asset value, so if you get a mortgage of 80% on the rental and borrow the 20% from a line of credit, it's very unlikely that borrowing 100% of that property value between those two amounts would cover off all of the mortgage costs. So in general, I would say it's going to be really tough for you to find anything where you're actually covering off the total cost. But from a tax perspective, yes, you might be cash flow negative there, but the idea here is that you're now saving money in tax, and what else would you be doing if you weren't borrowing the money? If you were borrowing it to invest in stocks, then you're gonna have a similar issue in your hands too. So I think that opens up a much larger question, which is, well, where do you invest to find positive cash flow? And some investors do find properties where they borrow 100% of the asset value and it actually puts money in their pocket, but it's quite rare. Larry says, very helpful information. Thanks, Larry. Nice to see you. Monique, does it make sense to work with you when I am in Toronto and you're in Vancouver? We do residential mortgages from BC to Ontario, and we do commercial mortgages across the country. So we're happy to help. I know that some people do prefer to work within their same province that they operate out of. In most cases, there is no real major difference in getting financing. The only thing that I will mention is that in some cases, we might say, hey, you know what, this is a trickier deal. Maybe we need a local credit union or something like that that we don't use quite as much. And we do have contacts in Ontario whenever that is the case. But most of these deals that we do, probably 85% of the transactions that we do are with major banks or non-bank lenders that operate across the country. And so it doesn't really make a huge difference. There's not really a lack of access to lenders, especially on most fairly basic deals. Edwin has a question. Thank you for the webinar this evening. It's been a while since I've examined my real estate investment situation. You've definitely got me thinking, and would like to get in touch with your group again to reevaluate your options. Awesome. Thanks, Edwin. So it wasn't a question. It was just some thoughts. Thanks. Nikolai has a question. When charging or changing lender upon term expire or refinancing, do you need to fully requalify with a new lender? Yes. So Nikolai, it's a good thing that you brought up too. If you're coming up for renewal, if you renew with your current bank, they don't reevaluate anything. So sometimes we have situations where clients come up for renewal and they don't qualify to even have the mortgage they already have. And in some cases, we'll say, hey, you know what, you should probably go back to your bank and renew. We can help you with that renewal too. We can just give you an idea of what rates are available in the marketplace and help you negotiate with your current lender to get the best rate, even if you actually don't qualify to go out and get those mortgages at all. So we can help you with that for sure. Michelle has a question. If you have a principal residence and an investment property, do you have to qualify for both with your income, or do they consider rental income or cash flow from the investment property? So yes, they do consider the rental income on the rental property. A really general statement is that lenders use about 50 to 80% of the rental income to help you qualify for a mortgage. So they usually don't use all of the rent, but they do use a certain percentage of it. Faye has a question. Do the banks equally consider all sources of income, so employment, investment income, rental income, pension, RSP, RIF, in the qualification? So with income, they don't use all sources of income. The ones that you've listed here, most of them would be acceptable in most cases. But there are certain things that lenders do not use. For instance, capital gains is a big one that we see a lot. Lenders generally need to see either minimum guaranteed income or what you've averaged for the last 2 years. So if you have income that you've had now but isn't expected to continue on an ongoing basis, they won't want to use it. Like capital gains from selling a property, well, unless you have a ton of real estate and you can sell one every single year for the rest of your life, they won't use capital gains. And even in that case, I don't think I'd actually have any success. I've only been able to use capital gains in 1 or 2 cases. Actually, a couple more cases, but if you're like a stock trader, for instance, or a part of your income is based off of the purchase and sale of stock, well, that would be triggering capital gains, and that is a situation where we could use that. But keep in mind that in general, they're looking for employment income, rental income, et cetera. And if you're pure rental income on your tax returns, it is more difficult for you to qualify for mortgages. They do like to see that you have some other source of income. Angela has the question. I have a rental at 3.09 fixed with 3.5 years left. The penalty is $9,100 on a $200,000 balance. Does it make sense to refinance with the new lender and pay for the penalty, or get a second mortgage with the new lender and take extra equity out? Current loan to value is less than 40%. So interesting question, Angela. We'd have to run some numbers on that and see if it makes sense. A really quick look at this is telling me that on $200,000, your savings to redo that mortgage would probably be about $7,000. And really, really quick back of the napkin math. So I think that you would probably recoup a lot of the penalty, but probably not all of it. So this is an interesting point. If you have equity tied up in your home, this is where we would need to look and figure out, does it make sense for you to refinance, and with which lender? We would see, well, it doesn't make sense for you to refinance with your current lender and just add another portion behind it. So it depends on whether there's a bank that can just give you a line of credit to use to invest, or what the situation is. But the really quick math here is if you drop the interest rate to, let's say, 2%, because that's the easy math here. The difference of your current rate and 2% is just over 1% per year on $200,000. That's $2,000 per year. Times 3.5 years, it's about $7,000 in savings. So I think you might be a little upside down, not a lot, but that's where we'd have to investigate a little bit more to see, well, are you with the right lender? Maybe we should set you up with a lender that has a Smith Maneuver product or something like that. And Armin said, thanks, Armin. The Rockstar Real Estate Investing book was awesome as well. So I didn't put it in this presentation, but I am also an Amazon bestseller. I wrote a book called Rockstar Real Estate Investing. And if anybody would like a copy of that, just send an email to info@greenmortgageteam.ca and give us your address. You'd be surprised how many people I offer a free book to, and they say, yes, I'd like a book. I'm like, okay, we do need your address to send the book. So make sure you send us an address we can mail it to. Another question is, hi Kyle, our principal mortgage is coming up for renewal soon and investment properties coming up next January. We'll be talking to you soon. That's great. Awesome. Thank you. Okay, I'm going to go back to the Q&A again because that's filled up. Arman asked, if you use the HELOC for rental investment down payment and get a mortgage to purchase the investment property, the rent you should, okay, yes, we did address that. So just to answer that question, it is very difficult to cash flow something if you're borrowing 100% of the asset value. And Nikolai had a question as well, which was when changing lenders, do you have to requalify? And the answer is yes when you're changing lenders, no if you're just renewing with your current lender. Bianca asked, do you take on clients outside of the Lower Mainland, Kelowna? Absolutely. In fact, with my franchise, my business partners are located in Kelowna. I lived in Kelowna for a year about 10 or 11 years ago when I was much younger and much better looking. So yes, we can definitely help with Kelowna. We do everything from BC over to Ontario. All right. Next one, Daniel Fung, what's better to invest in, residential or commercial? Daniel, that would be another topic for another day, but I'll touch on it really briefly because this is the question that comes up a lot. Residential financing is easier to invest in. If you are new to investing, I usually say start with residential. It's much easier. It's easier to wrap your head around. Commercial, if you're a seasoned investor and have a lot more capital to work with, commercial can be a better play where you can make a lot more money on one commercial deal, but you're kind of putting all your eggs in one basket. High level, residential, max 80% financing. Interest rates are, pretty standard. Sometimes the rates are premiumed a little bit over top of an owner-occupied mortgage, but they're pretty close. 30-year amortization is possible, and qualifications are based mainly on the individual themselves. Commercial, on the other hand, is quite different in the sense that usually down payments, it is varying because it is based off of the income the asset produces. And so they usually want to see that the income of the asset is 1.25 times all of the expenses, including the mortgage that you're getting. So just keep that in mind that your down payment can vary. And in general, 35% down is usually needed, and the purchase values are much higher. Not to mention, there's a lender fee. If you're using a broker, there's a broker fee to shop it around. Appraisals are more expensive. Environmental studies can be 5 or 10 grand. Legal fees can be 10 grand. So a lot more expenses, but there's a lot of other reasons to consider commercial. I have done webinars about commercial financing as well, and I'll probably be doing one again in a couple of months. So. Justin has another question. At what point does the bank look at the total amount of rental properties, total revenue of you versus the income? And at what point do you move into this commercial lending? So good question, Justin. So in general, if you're getting residential financing, they will always be looking at what your income is. They don't want to ideally have a situation where you don't have a third party non-rental income source. So the question often is, how do I quit my day job? Because that's what this is what I want to do. I want to quit my day job and be a full-time investor. It's very, very difficult and challenging on the residential side. On commercial, it's a bit easier to pull that off because they're looking more at the income of the assets and what the income is there. So it's a really hard question to answer because it varies quite a bit. But when you get to 5 to 10 properties, that's often where you need to start looking at commercial because you're running into more challenges. In general, lenders are having, a lot of them have a hard cutoff at 5 properties total. And there's a few more that can go up to 10. And so if you have an income, you're strong qualifications, you could continue buying up to about 10 properties. But at some point you will hit a wall. Maybe you hit the wall a little bit later than others if you have a good income, et cetera, but you will eventually hit a wall. So about 5 to 10 properties is where clients start to look at commercial lending. Iman asked, how is the rental income calculated for mortgage purposes? So if you're buying a rental property, they usually use between 50 to 80% of the rent. That's the very generalized term. Every lender has a slightly different method of calculating the rents, but it's usually about 50 to 80% of the rent. Kelly, great presentation, Kyle. I'll be in touch. Thanks, Kelly. Nice to see you again. Lisa has a question. What lenders will have a Smith Maneuver product and what does that look like? So any lender that has a home equity line of credit can do the Smith Maneuver. So there is no specific Smith Maneuver product. It's just that you have to have a home equity line of credit to be able to activate and use the Smith Maneuver. And so any product that is what's called readvanceable, meaning that as you pay down your mortgage, your line of credit limit increases, is a product that you can use for the Smith Maneuver. There are certain lenders that all you have more or less accounts within the product, et cetera. So there are some minor moving parts to that, but in general, any type of HELOC product is sufficient for that. Justin has a question. How does locality impact mortgage qualification difficulty? So small remote community versus large urban center. With major banks, you'd be surprised, but it doesn't have much of an impact. Sometimes if the property is in a very small town, then that can be something that would come up. But in most cases, it's not the case. Usually, a major bank will finance up to 80% of the value, even in smaller towns, because they're looking more at you and less at the property. Where things get more challenging, though, is if you're starting to look at B lending or commercial lending, then they are starting to look more at the property itself. And in particular, private lending, that's very, very difficult to get a private lender to lend in a small town. So sometimes you're buying a property in a small town, So this is a lender or bust if you need 80% leverage, because the banks might do it if you can qualify with them, but if you can't get it done, then B lenders often don't go there, and private lenders often don't go there. Emad had a question: for residential property, my bank wouldn't give a 30-year mortgage. Why? Is it possible? I'm a little curious as to why they wouldn't, unless you put less than 20% down. If you put less than 20% down, then the maximum amortization that you can get is 25 years. If you put 20% down or more, then you should be able to get a 30-year amortization. Sometimes, though, the pricing is better on a 25-year amortization. So they may have told you that maybe you can't get that rate if you went with a 30-year. But unless you put less than 20% down, a 30-year amortization should be an option for you. Or if it's commercial, then a lot of the time commercial amortizations are 20 or 25 years. Another question here. So Scotiabank had implemented a restriction in utilizing HELOC for down payment of new purchase, but I think they've since canceled it. Do all lenders allow use of HELOC now? Any talks of not allowing in the future? Yeah, so that is true. But Scotiabank has pulled that off the table, and so now you're allowed to borrow money from a home equity line of credit for the down payment on a rental. So that is possible. So I don't expect that rule would come back. I think it was a bit of a silly rule in the first place. So I don't really see that rule coming back anytime soon. Another question: is it better to purchase an investment property as an individual or under a corporation? It depends. It's a tough question to answer. High level, there are costs involved to incorporate. You're going to be paying a couple $1,000s a year just to do the taxes and the financial statements and keeping your company up to date. And on top of that, a holding company is taxed at a very high tax rate, very close to 50%, whereas an individual is often taxed at a lower tax rate or maybe in the high tax bracket, the same. Now, reasons to incorporate: number one, if you own an active corporation that's earning an income, then it would make sense for you to earn in the income here in the active corp and then lend it to the holdco that then buys the assets. And the reason you do that is that then you're investing pre-tax dollars. You're not taking the income home, paying personal income tax on it, and then lending out investing the rest. So that's number one reason. If you do have an active corporation already that's earning a surplus income, it can then make sense to set up a holding company to purchase the real estate investments. The second item that would make sense is if you're trying to build on a very large scale. And so if you're trying to buy 5-10 properties plus, then something that can make sense to buy in a company name. Another reason that can make sense to buy in a company name is if you're buying a commercial asset. In most cases, it actually makes sense to do it in the company name in those cases because you're buying a really large asset. So the real reasons to consider it are, there can be tax advantages later on, especially with estate planning. But in general, it is more expensive in the meantime because you're paying taxes, higher taxes to do it. You're paying an accountant to file those taxes. And on top of that, it is harder to get a mortgage in a company name in general. So you have less options, and sometimes fees can apply or sometimes rate surcharges can apply. And in many cases, the lenders use a different department altogether to underwrite those deals. And those departments can be slow or have slightly different ways of underwriting it. So lots of moving parts there with, whether to buy it in a company name or personal name, but that's the quick hits on it. Emad, would you consider getting a first-time homebuyer incentive if you have rental properties and qualify? So the reality is, if you have not claimed your first-time homebuyer incentive yet, and you've purchased rental properties, you can still qualify if you purchase a residence to claim the first-time homebuyer grant. So it just really depends on whether you filed it already and if your intention is to live in it. I will warn you that if you're intending on saying that you're going to live in it and not living in it, the government does check in on this. And I've had some clients that said they're going to live in the property, didn't actually move into it, and then a year later, they got a bill for the property transfer tax sent by the government. So just keep that in mind that you need to be careful about that. Lisa, can you put down 5% down on a second home or vacation home? Yes, you can get as little as 5% down on a vacation home or second home. So if you're buying a property that yourself or immediate family are going to use, or if it's a vacation property, you can put as little as 5% down. One thing to be aware of here is that you're getting insured through CMHC, and so CMHC fees apply. Maximum 25-year amortization applies. But on the flip side, it's great to be able to put that little down payment down on a property. So yes, it is possible. Just keep in mind that you're not using any rental income to qualify you. And so it may be more difficult or more challenging to qualify for a loan of that size because you're carrying your own personal debts, plus you're carrying the entire mortgage on that property without any rental income to offset it. Unless it's a multiple unit property. So if it's 2 or 3 units, you can use some rent from the other units that you would not be residing in, or your family member wouldn't be residing in. Elon, I did put 20% down for the rental property. The bank said 30-year mortgage is not allowed for investment properties. So Emad, I think that sounds like a bank rule or guideline. I'm a little bit surprised that they said that they couldn't do it for investment properties. The only other thing I can think about is that sometimes the property itself, if the remaining economic life on the appraisal is not long enough, it has to be 35 years. So whatever amortization you're asking plus 5 years. If you're buying a really old house, the effective age and therefore the remaining economic life of the property may have only been 30 years, which would have been a maximum 25-year amortization. But again, I think that's something that I'd love to chat you with, maybe take it offline and see if we can help you out with that. Awesome. Any other questions, guys? Thanks for sending over all these questions. These are great. All right, I've got a theoretical question. Love it. Let's get into it. All right, here's a theoretical question, at least for today, I hope. If I die, okay, that's right, it's a theoretical question. If I die, my wife not on my rental mortgages, will the banks foreclose on properties if my wife does not qualify for mortgages in place or does not pay off outstanding amounts, say from insurance proceeds? If foreclosure is unavoidable, how much time? So the lender will, and this is where it gets a little bit tricky. Technically, they're supposed to requalify the remaining spouse in that situation, but if the payments are being made on time, they usually won't. So technically, they're supposed to requalify the individual, but usually they will not do that. It is a reason to very seriously consider adequate insurance to make sure that you don't put your spouse through a situation like that. So if you have any questions about insurance, we do have contacts for that, but it is something that obviously is a bit of a concern in trying to make sure you plan for what can happen. But I have had it come up. I have had it where the bank says, oh, I don't know if this person's going to qualify. And then they end up usually finding a way to just make it work as long as the individual is still making the payments. Especially on rental properties, you would hope that there's still enough income from the rentals to cover off all of the payments. So it's hard to answer that because it is a case-by-case situation. And I have heard about it happening. I haven't had it with any of my clients, but I have heard about the bank saying, oh, sorry, this person can't qualify for it. Linda asked, say on that topic, mortgage insurance versus life insurance. The difference really is that mortgage insurance pays off the mortgage in its entirety if something was to happen to one of you, or make the payments if you're on disability. So it's a bit different than life insurance, which is not tied to the mortgage at all. So if you have a life insurance policy for $1 million and something happens, then it just pays out $1 million. So there's a bit of a difference on the product. For mortgage insurance, it is on a decreasing balance over time, but yet your payment remains the same. So you're receiving a smaller benefit, but still making the same payment per month, which is a negative against the mortgage insurance. On the flip side, mortgage insurance can sometimes be cheaper, and it's tied to the mortgage. And another thing is that when you go to get an insurance policy through a financial planner, you typically have to go through a process. So you usually are peeing in a cup, and they have to determine what your health is and see if you qualify. Where in many cases with mortgage insurance, it's pooled insurance, which means that they just throw you into the pool, and they know that some people are paying higher than they should be rates, some people are paying less than they should be, and it just averages out overall. So in some cases, we've found that some clients cannot get regular life insurance, but they can get mortgage insurance. But you're typically not covered for any pre-existing conditions under mortgage insurance. All right, let's see here, another question. Okay, so what I'll do is when I email everybody out the information tonight, I'll make sure that we send you guys the link for any previous webinars as well. They should be on the website, but frankly, I actually don't know where they are, so I'll make sure that the team sends out a link to any other previous ones. Maybe they're on YouTube, but we should have a link there. Bianca has a question to briefly touch base on green wealth. So yes, I didn't really go about or talk about it today, but this company right here, that G, Green Wealth is a real estate investing consulting company that I started up last year. Basically, what Green Wealth does is it, in essence, is working with primarily investors to figure out how to build a real estate portfolio and how to grow their portfolio, especially with clients that run into a bit of a wall. So a lot of the time when you have 5+ rental properties, things get a lot tougher and tighter. And that's where we step in and try to dig a little bit deeper and figure out, okay, how do we get these deals done? One of the things that's been happening in the last number of years is that as lending keeps getting tighter and tighter, as a mortgage broker, we deal with about 40 different lenders to find clients the best rate and best product, and then we get paid by the lender. But when you have a more complex structure, we find that those 40 lenders just aren't enough. And so we're often having to shop more lenders, including banks that, there's a few banks that don't work with mortgage brokers. And so we will actually engage and talk to them and work to get the deal done. And in the past, we used to get those deals done, send them to the branch, and then charge our clients a fee to do that and find a home. So what I did is I created some internal software that actually underwrites for all of the lenders for our clients that are inside of Green Wealth, and then engages and figures out, well, which lender is the ultimate best fit for you, primarily on who's going to be able to qualify the deal and get it done. So we tried to double down and figure out how can we help our investor clients more. Of course, there's a lot of advice and input that goes into that. I had a client that was onboarded with Green Wealth today, and he's coming into a decent sized chunk of money. And so we talked about what the plan is going to be, the different strategies that can be involved with building a real estate portfolio. But also now we're starting to engage with the client's accountant to go over what's the right corporate structure. Should we set up a new holding company or not? Are we able to also set up a separate active company to be able to shift some of the cash flow from a high tax bracket to a low tax bracket? So really diving really deep into it. Honestly, there's quite a bit to dive into about Green Wealth, and not enough time to explain it here. But if you'd like to have a chat with me, Bianca, about Green Wealth, I'm happy to do that. Awesome. Rajat had another question. Is there any rule of thumb for economic life of a property? Not really, no. Most properties are going to be rated as about an 70 to 80 year life. But if it's been renovated and kept up in good shape, then the appraisers kind of add time to that. I will say this, it's very rare that I get a property that comes in at less than 35 years economic life. And that's primarily because the appraisers don't want pushback from brokers, because when they changed that rule, I think it was around 2010 or 2011 when they started to be a little bit pickier about what the economic life was in the appraisal reports, and then brokers were complaining and saying, "Oh, I needed a longer amortization." What they started doing is just basically saying, "No, the economic life is 35 years as long as the individuals upkeep the property and keep it in good shape, etc." But if you're buying a property that is almost a tear down and it's obviously going to be redeveloped, then it will be tough to get a long economic life, which then makes it hard to get a long amortization. Number 2, is there a property which is 100-year-old, then theoretically investors can't buy? Not necessarily. Again, maybe if it's in a development area and it's very run down, then that'd be tough. But if it's a 100-year-old house and it's in good shape, then it's very simple and straightforward to get qualifications for that. So not a problem there. Okay, and it looks like Todd had a question about rental financing on leasehold land. So yeah, I think Todd, I spoke very briefly to Michael, so I think he's looking into that for you. But one of us will definitely get an answer to you on that. And I think Michael's just looking into some options to figure out which lenders might be able to do that for you. Dustin said, "Good job. Thanks for the webinar. Looking forward to working with you in the future." Awesome. Thanks a lot. Cool. And Rajat, thanks a lot. I'm glad to see you that you came out. So thank you. All right, Q&A. Lisa has a question. So if I move a property from having both my husband and my name on a mortgage to just having his name on it, will that be an issue for the bank if the rental income is covering the mortgage? He'll be retiring before me, so I was thinking it may make sense to try and do this before to have the taxes attributed to him. Interesting question. So from the mortgage qualification perspective, if it's just going to be him on the mortgage, then he would have to be able to qualify to carry it on his own, which may or may not be possible. That's something that we'd have to take a look at. Another option too, Lisa, is you can talk to your accountant and lawyer and see if you could adjust it so that the title is 99% in his name and 1% in your name. And that might be a way of then having 99% of the taxable income go to him and then only 1% of the taxable income go to you. Keep in mind that on a rental property with a mortgage on it, in general, the properties are going to be net neutral on your tax returns. So by the time that you factor in the rental income, but then all of the expenses, it usually brings you back down to zero. And so it's not really until you have that mortgage, paid down quite a bit or paid off, where eventually there's a taxable income, a positive taxable income on it. So it's probably a issue for later. Of course, you want to make sure you set it up properly from the get-go, but one way of doing that is maybe just to change the title to 99 and 1. Eman has a question. For my 8-year rental property, is it fair to assume it is appreciated at least 3% or 24% total? Depends on the market, but I usually use for my models, I usually use a 3% annual appreciation on a projection basis. Certain markets, I might tone that down to 2%. Certain markets, I might bump that up to 4%. Greater Vancouver, the annual appreciation for the last 25 years or so has been about 6% year over year. I wouldn't expect that to continue. I think it may actually still continue, but I wouldn't use that in my models to assume that moving forward. So a really good general rule of thumb is that usually real estate on a large scale appreciates at about 1% above inflation. Target inflation is about 2% with the government. So you can bank on real estate probably appreciating around 3%. That 3% is probably closer to the Canadian average, but different markets would have higher or lower appreciation. Christine asked a question, can the foreign buyer's tax be included in the mortgage? No, so you cannot include foreign buyer's tax or property transfer tax, and you cannot roll those into the mortgage, but you can roll the net GST into the mortgage. So the lenders will lend on the net GST on a mortgage. Awesome. Any other questions, guys? Awesome. Thanks, Angela. Well, I hope you guys enjoyed this. Obviously, if any other questions come up, please reach out to my team and myself. We're happy to help. The next webinar coming up next month is on first-time homebuyers. So I know a lot of you are not first-time homebuyers, but if you do have anybody who is interested in buying their first home, we will be happy to help them out. And that webinar will be on April. When is it? That one will be on April 7th at 7 p.m. So we'll be doing that in the future. And yes, Angela, I'd be happy to chat with you about Green Wealth. Just send us an email and then we can set up a talk about Green Wealth to see if that's the right fit for you. Thanks, Todd. Good to see you. Awesome, guys. Thanks a lot. I'll close this down now and just reach out if you have any questions. Thanks a lot, guys. Have a good one. Bye now.